Alright, if you're watching this video, then you're watching the add-on version of the Gap game plan. And originally what I had was a two-part series of the drift and other indicators. But what I'm going to do now is I'm going to make it into a different version because the strategy has changed a little bit by adding one indicator and kind of demeriting another one. So anyway, this upgraded version is going to show you 4 additional indicators we can put into our gap game plan system. If you recall, we have gaps already and we have candlesticks. Now, this fourth indicator, sorry, the third indicator, what's going to act as our third brain in this system, is going to be a combination of these 4 indicators I'm going to show you. So recall that we're going to do a gap analysis and then a candlestick analysis post gap. And based on those 2 analyses, we're going to determine whether the gap or whether the stock is bullish or bearish. Now you've got a couple situations here. Let me write them out. It's actually a 2x2 table. It could be that the gap is bearish or bullish, and the candlestick pattern is bearish or bullish. Now, obviously, if you have a gap that's bullish and a candlestick that's bullish, you're going to want to play that bet. You don't need to even look at the third brain. But what happens if you get bullish gap and a bearish candlestick, or you get a bullish candlestick and a bearish gap, or alternatively, you might get a gap that's confusing, or a candlestick that's confused, or like no candlestick pattern at all. So you have these. It's actually a 3x3 pattern here. So it could be that the gap looks like a breakaway gap in terms of volume, but not in terms of where it's trading. Or it looks like an area gap because it's in the trading region, but the volume is very large. In that case, we would say the gap indicator is indecisive, and we're not going to use it, but the candlestick might be bearish. So what we're going to do is we're going to add a third brain. So I'm going to just call this the third brain. And it consists of 4 different indicators, which also could be bearish, bullish, or indecisive. And we're going to add up these indicators to determine whether the third brain is bearish, bullish, or indecisive on the pattern. So I'm going to go ahead and teach you those 4 indicators. I'm making this a screen cap video so I can show you the free sources I use to determine these indicators' bullishness or bearishness. So the first we're going to want to look at is, and I've called this drift and other indicators for a reason. The first you're going to want to look at is drift, and you can use any stock chart. I'm just going to use a market watch. Drift is important because it has 2 things going for it. First is statistical backing. Drift has been well studied. And second is, if you go with drift, what you're using is a long-term indicator, whereas the gap and the candlesticks are short-term indicators. So what really happens is you might think a long-term indicator like drift is not so useful for a third brain because it's long-term and we're doing swing trading on gaps and candlesticks. Now if it's long-term, it actually does have one thing going for us. If, for example, we have a bearish gap and a bullish candlestick, in other words, one of our indicators says to go up, the other says to go down with the stock. Now, if drift points in one of those directions, we're going to want to go in that direction because what happens is drift is going to give us a long-term prediction. So even if we are wrong, drift is going to bring us in a direction that is with the drift. So we're going to want to bet with the drift in the long term. So the idea here is you buy the stock. It doesn't go the way you wanted to, but because the drift is bullish, you're eventually going to make money on that stock. The stock is going up slowly. Now there are 2 places you can look at drift, but only like a stock chart like Market Watch will give you the main idea here because you're going to have to look at it twice. I'm going to show you why in a second. Let's just choose a stock like XLE. It's actually it's an ETF. So let's not do an ETF, but you can. Why not? Let's not do this one. All right, let's move on to win. Okay. All right. So what we want to do first is go out to 1 year. And I give the entire process in the Step 4 checklist and the drift and other indicators ebooks here. But essentially what you want to do is you want to look at whether it's going down or whether it's going up and whether we're at a low or a high for the year. Statistically, a stock that's at a 1-year low continues downward, whereas a stock that's at a 1-year high continues upward. So statistically, WIN is going to continue downward. But there is a caveat. You also want to look at the 5-year drift, because in 5 years, it tends to reverse. So if we're at a 5-year low, like we are now, then statistically the stock is going to go back up. So we don't want to be confused by the first year, because the first year is often going to tell us just a short-term drift, the intermediate drift. But the 5 year is going to tell us if there's a reversal possible. Stocks tend to have this reversal cyclical pattern. Every 5 years, they reverse. Now, in this case, you might want to go back to 6 years and see if the reversal actually started at 250 and it's going to go down for another 5 years. That's possible. But generally, you can just make a safe bet by looking at the 5-year one. It is possible that it does reverse, but you don't want to put too much effort into analyzing all of these indicators. I designed the gap game plan to be a fast method of predicting stock direction, and that's also the reason we are using 4 indicators instead of just 1. We don't want to be wrong on drift and put all of our weight into that as our third brain. We want drift to combine with some other indicators, and if a couple of them are wrong, that's fine, because overall, by the law of large numbers, the indicators are going to be correct most of the time, and adding them together is going to give us a conservative third brain. So the gap and the candlesticks, while statistically accurate, aren't really conservative. The third brains can be conservative because we're pooling indicators together. So I'm going to say WIN is bullish because in 5 years it's at a low point. It's at a pretty low point in its 5-year career. And that is drift. So that's the first thing we want to look at. And the second one, actually, there's a website that gives us all of the next 3 indicators, which is stockta.com. So let's go ahead and put in WIN. So here's how I do it, like if I wanted to write it out. So the drift, so we're doing an analysis on WIN. All right, drift is bullish. Now we're going to look at the other ones. I'm going to write them down. First is support and resistance. Next is Fibonacci's. And the third is stochastics. Okay, so support and resistance are these red lines or green lines you see here. They act as walls. If the stock is going to be below a red line, then there's a wall above it. It's going to be hard for the stock to break through that wall. That is a very bearish sign. Alternatively, if you see a support, there's a tiny support down here, but it's not strong enough. It's not a solid line. If you see a support, then it's going to be hard for the stock to fall below that number. Now, obviously, we're right below a very strong resistance level, and that's going to give us a bearish indication. So that's what you want to look at next. Over here, it gives you the numbers. You want to look at a support or resistance with high confidence. If, however, WIN breaks through this resistance, that wall will re-seal and become a support level, and that's usually when investors like to get in. But we're not going to be so simple. We're not going to just use support and resist. We're using a lot more indicators, and using support and resist as one of our pooled indicators for the third brain. So far we have a bullish indicator and a bearish indicator, and you're going to see how this works out in the end, because honestly I think this drift as bullish, it's probably not right. It's probably made the reversal already at 250, and it's probably continued down for quite a while. But in the short term, we might be bullish on WIN just because of the candle and the gap. But we didn't do those 2 analyses, so forget it for the moment being. Now let's move on to the next one, the Fibonacci's. All you have to do is scroll down to where it says Fibs over here. Make sure you look at short term, because we're swing trading, and see if it's red or green. In this case, it's red. It's bearish. So the Fibonacci's gives us bearish. Now what do the Fibonacci's mean? The Fibonacci's tell us the probability that if the stock begins to move in one direction, that it will trace back its tracks, it'll reverse. So if it's bearish, what it means is when the stock tends to go upward a bit, it also has a tendency to trail backward. So you'll notice here it goes up a bit and then it trails backward, goes up a bit and then trails backward. So what we're saying here is that the upward trends are always in the short term and they don't last very long. So if we see an upward trend, we only want to ride that for the short term and get out. If the Fibonacci's at the moment are bearish, it means we don't put a lot of effort into the bull. We don't put a lot of faith in the bull. We put a lot of faith in the bears. So that's our prediction here. And lastly is stochastics. Here it's neutral, so we're going to say it's indecisive. So let's do a quick recap. We got bullish, bearish, bearish, and indecisive. So we're going to say that the third brain indicator in total is bearish, slightly bearish. All right, but what do the stochastics mean? Stochastics generally after a gap aren't very reliable, which is why you want to be careful when you're using these. If it's been a few candlesticks after the gap, you can rely on the stochastics, but like after a breakaway gap, for example here, after this point, you wouldn't want to trust the stochastics because the formula that calculates the stochastics kind of goes out of whack when there's a gap. Anyway, overall, when you're looking at the stochastics, what it means is it's more or less an indication as to whether the stock is oversold or overbought. And as you can see, it's kind of trailing at one place. Stochastics don't tell you, in this case, that the stock is overbought. It also doesn't say that it's oversold. So it's probably at around market price. You can think of these stochastics as a measure of whether the stock is trading at a fair price or not. Okay, so overall, those are the 4 indicators you use for that third brain. Then you put it all together and you take 2 out of the 3 or 3 out of the 3, depending on how conservative you are. I believe in the next lecture, I'll talk about the risks involved with trading stock versus options. If you're going with stock, drift is a good indicator. If you're going with options, usually you don't care so much about drift. So that's another thing to take into consideration. If you play with options, you can actually delete this and just use these 3 for your indicators. And I often do because I usually gap trade with options. But if you're playing with stock, take them all into account.